Does global central banks know something we do not? They are buying gold by the truckload. In the past, such gold stockpiling led to an economic unrest that was hidden somewhere around the corner. Do they expect an introduction of this foreshadowed doomy and gloomy global world order, the new global world order, when the fiat currency will get obscured sooner rather than later? The realm that you won't have nothing and be happy, merely by wearing virtual reality headsets and don't bothering about anything else. But right now, let's get real. It's Thursday. Everyone was glued to their screens Thursday morning waiting for the latest consumer price index. But if you weren't, all is not lost yet. There is a Blockrevision to help you out with all the intricacies of the stock market, and we are going through from stocks via commodities to crypto, everything at today's episode. So I'm very glad to host you today. Let's begin our show. All right, economy view is the sector we are commencing our broadcast with. At first, as a reminder, there is a chat going live. So if you right now watching this transmission, you may pose questions right away, and don't forget about subscription if you wanna have updates about what's going on the markets. So at first, what has been happening? So CPI is right here, 6.5% in December of 2022, and that was widely discounted by the market. But let's find out what was once again, as a reminder, if you haven't watched yesterday, the projection of JP Morgan for such data. Right here, you have a JP Morgan's game plan on CPI day. So it got to 66.5%. So it was the most likely outcome. So I would expect rather to have the market reaction as a sell the news event when the market has expected this one with a 65% probability rate. So S&P 500 is predestined to rise, but at first, as the majority of the market already knows, that it's expected to have the index rise. At first, I do expect a little pullback. Let's find out what's happening on Nasdaq right now. US 100. What we got? Oh, exactly. Whoa, what a slide it was. So it was really a sell the news event. So we have shaken out long positions that were just joining the current publication time, and right now I would expect that after confirming previous high, there will be undistorted move upwards. But for now, we need to tackle with that ahead supply that will be kind of difficult to overcome. But hopefully we manage. As on a daily chart, US 100 looks like it formed a floor for the rebound out of this area of 10,500s. Okay, so we are getting back. Sorry, haven't I showed the right windows? Oh my gosh. All right, so once again, clearly, US 100 was shaken out. Why didn't you let me know about this in the comments or the chat? I will switch it over now more quickly. So the US 100 once again is shaking off long positions, and right now is building kind of a shaky, choppy base for growth. So it's 4-hour chart, and I've thought about this overhead supply. So we are jumping back to our presentation. So mainly it was dictated by lower gasoline prices, which offset increases in shelter prices. So that's what happened, and that's what gives the Fed power for next interest rate hikes, but maybe around I would say not 0.25 but 0.5%, if you ask me. So it may be higher, but regarding that the markets are getting ready for the rebound, it may be maybe even this 0.25, and that will boost the stock market the most. But for me, 0.5 is more likely, more reasonable, as I would say, if I say so. But the markets, the stock market says we need a boost in order to get a rebound out of this suppressed area of US hundreds and also SPX recently, and that boost might be this 0.25 interest rate hike. So that's what I those safe things. Heading next, BlackRock, and BlackRock staff cuts. So BlackRock plans to dismiss about 500 employees, roughly 2.5% of its global workforce. So 2.5% is not a tornado, right? Their breadth and resilience gives them a chance for staving off that recent market turmoil and go relatively unharmed through this current recent circumstances. So acquisitions and deals were slammed. That's obvious. Clients focused on defensive part of investing, about saving the capital, and also the crypto winter that curtailed the sentiment around investing world, and FTX case that discouraged many from investments. That everything add up. That's why also this slump in liquidity is everything coming into a bottom line that those cuts were necessary. For now, the company is too big to fail. They will stay ahead of changes in the market and focus on delivering for the clients, obviously. But it's very difficult to collapse the business that's so tied to the government structures, whose services are used by government activists and prominent, if I may say so, politics. All right. So in terms of those cuts, on Friday we have earnings. So we'll be looking at many banking companies on Friday, not only of traditional finance as BlackRock, but also other much more engaged in a digital assets world. And there will be a litmus paper for what may come to the economy next. So there is, as I said, JP Morgan, BlackRock, also BNY Mellon that I mentioned about digital assets, that also kind of interesting to get track. So we'll be very, very closely looking for signs of how that's going. All right, and next, what we got next, is it an end of the fiat standard? Right now, as central bank gold holdings return to 1970 levels and rising at a fast clip, while many of market analysts are tracing buying to China, it's not entirely clear to them what's driving those purchases. So, given the bearish macro backdrop, speculative interest in gold has remained exceptionally lackluster as the world barrels towards a recession. That's what said senior commodity strategist Gali. But yeah, I know there's a lot of speculation around what's going on underneath. But when a fundamental aspect of such buying spree of central banks has been in the past, and when I would say, what was the fundamental aspect of the buying spree in the past? In 70s, the answer was only one. The US abandoned the gold standard in 1971 to curb inflation, prevent foreign nations from overburdening the system by redeeming the dollars on dollars for gold. So on April, President Roosevelt issued a proclamation that formally suspended the gold standard, and that was the proclamation that prohibited exports of gold and also the treasury and financial institutions from converting currency and deposits into gold coins and ingots. And then cash experiment has come, or so-called petrodollar. But it doesn't mean it's based on an oil or anything half like that. USD became a notional unit of currency earned by a country from the export of petroleum, which value and purchasing power depends on institution called Federal Reserve of the United States. All right, but getting back to the point, why gold is rising. One thing is the global economy that becomes more fragmented, with access to critical commodities more difficult, that governments around the world will feel a greater impulse to accumulate stuff rather than US dollars. The world also discovered last year that not all dollars are the same after Russia was cut off from its dollar holdings. On the other hand, that's what happened recently with inflation causing impoverishment, consisting in lowering the standard of living of individuals and communities. So the goal of the government is to reduce the purchasing power of society so that it does not have the ability to increase asset prices, and on the other hand, it's about lowering the value of hard assets in order to be able to do some kind of structural reform. So the outlook is quite pesky. And following this, is CBDC alongside with debt cancellation a solution? So does those particular sides, whether it's China, whether it's Russia, are protecting themselves of something of that to happen? So CBDC is nothing good, if you ask me. They are trying to introduce social credit scores, vulnerability to state and foreign actors. Banks will have full control of every penny you own. There will be merely little or even zero privacy. Also, we will have zero anonymity. We'll have frozen funds, and every transaction will be documented access to your dollar that can be turned off at any moment. So if you're holding gold, that might be your ticket to the freedom. So don't leave it and don't drop it yet. Buying gold alongside Bitcoin, but this time the gold is the one to thrive. As the Bitcoin is not as widely known and widely accepted as gold, as it would take time for this. So buying gold and holding gold might be the one of the passport to get through hard times in the economy. So that's what about that elements. Right now we are heading to market outlook, and I have for you kind of interesting charts. First, I would like to show you the skew. Oh, look at this, US 100 already taken off, but getting back the skew on a weekly. So the skew measures perceived tail risk in the distributions of S&P 500 investment returns over 30-day. Sorry, I haven't. I show you out once again the US 100. So US 100 is taking off last right like this. So getting back to skew on a weekly. So the index of skew increases general market awareness among investors. As the slope of implied volatility moves higher, it raises the skewed index, which indicates that a black swan event is becoming more likely, but not it will actually occur. The gauge leans on volatility, and unlike VIX that's based upon implied volatility around the money ATM strike price, while the skew considers implied volatility of out of the money strikes. So it's a bit more experimental and quizzical, if you ask me. But it gives us a chance of finding out whether there is a chance of occurring a black swan event on the market. So when it rises, when it was back in June of 2021, out of this some circumstances, there was a high possibility, high eventuality of those black swan events to occur. We were rising back then, and there was lots of easy money on the market. Right now, we are getting back to the lows of 2019 and even 2018, where there was a time of a very strict rebound on the markets. During October 2019, there was also very nice rally by the end of the year. So as extension, just have a look at this one. So skew looks kind of a interesting in terms of its future performance. Also, let's have a look at RSP. I will show you to SPX on the monthly. If you want to have a look. So there's a chart which shows that the gains in US stocks are being built on many, not on few companies. So the breadth of the share prices really is increasing, and this RSP adds a breadth of the market towards in relation to S&P 500. So its market cap, its breadth against a market cap. So that's a much more healthy situation than we had in the post-pandemic liquidity-driven rally, when tech stocks bore the weight of the bull market. So it's kind of a interesting to watch how they play out, but it looks like we are getting back to NATO. Much more positivity on the markets. So that was about it. Right now, getting back to slides and crypto outlook. That's very interesting. Is it a weighted bullish sign when we have many crypto companies, mining companies that are getting away of the market, whereas the hash rate is stable? It looks like cash-strapped Bitcoin miners are reducing loans and scaling back their operations as the crypto mining industry continues to weather a plunge in the digital assets price. So we can find that the cash flow activities of public mining companies, sorry for the low small picture, but it looks like debt financing is lowering by Q3 of 2022 by 112 million bucks relative to what was 2 quarters before. That was 348 plus. So right now many of miners are getting away of the market. Let's have a look what's happening on on-chain data. Right here you have a miners position index. So it literally means that the higher value shows that miners are sending more coins than usual, which indicates possible selling. If miners send some proportion of the reserve, at the same time it could trigger price drop. So we had price drops back the most at April of 2022. That's where the slump has been observed, and also that coincided with a downturn on major US indexes alongside commodities. But also we've seen such behavior back in November. Right now, we can find that the positioning of miners is pretty stable. So that's positive on the market, and I would also depict that nearly anyone was selling back during this local high at 13th of December, where it was Fed's meeting back then. So that's positive to watch. So that's very positive by large. Right now, let's get back to our awaited bullish sign, and so miners are trying to deleverage to avoid margin calls on an imminent liquidity crunch if Bitcoin drops below a certain price point. The reason is falling Bitcoin prices and soaring energy costs for its cash flow issues. So many of the companies have been already underwater, and that's why we can find that who was about to sell already probably sold, and that's a bullish for the market. Doesn't mean that all bad already gone for the sector, obviously not, but the price doesn't react for bad news, at least for now, so it's a very bullish sign. And market mover section. What we have right here is the economic calendar. Obviously, we are through inflation rate and all of the data related to this. Initial jobless claims. Let's have a look. So we are dropping in jobless claims, so it's positive for the market and gives room for further hikes. Maybe not of 0.75, but something smaller. But we are waiting also for tomorrow's GDPs of Great Britain and consumer sentiment of US from United States, Michigan, University of Michigan. That's expected to get once again get at the similar level of 59. So it's much more optimistic right now than it was back during the summer. So in terms of earnings calendar, so investors are relieved to have turned the page on the worst year for stocks in more than a decade. Investors right now are finding that pricey share valuations and shrinking earnings still stand in the way of any swift bounce back for big tech, and that's what exactly can be found, that those companies may set the scene for the future outcomes, and also the sentiment will be related to the outcomes of tomorrow's uh, that are being delivered. So we can find that many of the companies alongside Apple, Meta, Amazon may have kind of a negative outcomes when it comes to earnings calendar. I will show you also the projections for this, and we'll get back into our presentation. So S&P 500 changing forward 12 months EPS versus changing price 10 years. So I haven't changed. I haven't found much more quality picture. So I will show you out as it goes like this. So forward 12-month EPS right now is going downwards, but it's not still something horrible at the side, and it's like we've reverted to the mean. So we are discounting, getting to reality of what is underneath the economy without such liquidity from Fed. So right now it looks like reality eventually hits us, and as we've already trying to discount current downturn relative to what was back 1 year ago, we may try to eventually assess the prices in the right way without significant exaggerations. All right. So that's very interesting how it play out, and also that's a very interesting chart as well. So Morgan Stanley earnings indicator right now is showing that we may get even worse in the second quarter of this year, but it's no much of a room for discounts, but earnings per share growth may get lower down to 2023. So second quarter of 2020, and even maybe a bit of third quarter of this year might be a bit more troublesome, but without any much of a calamities. So in quarter 4 2022, the estimated decline in earnings for the S&P 500 is minus 4.1%, and is the actual decline in this quarter will be the first year-on-year decline in profits since quarter 3 2020. So that was about earnings, and right now one of the most interesting for you definitely elements of transmission is of Blockrevision is a trade idea. What we have around the corner. My proposition for you is today a WTI USD. So what we have right here. It looks like we are negating the slide downward. I've expected previously that WTI will get back to area of 60ish, low 60ish, but we are defending. There is many of a bull stepping in, and right now, if I just turn on my drawings, there is an inverted head and shoulders yet to be built. So I do expect WTI USD to get through this line, and as it comes from a head and shoulders, inverted head and shoulders formation, we will have the objective set as a distance from the bottom of a head to the neckline in a straight line, and it moved to the point of a breaking point. We'll get exactly the growth to the previous highs. So it means we still have right from here around 17% of growth. But for this one to happen, it will be an excellent if we just get over this neckline that has been right here marked. So if it gets through, we'll have a very nice territory to thrive for WTI. Also, JP Morgan, was it JP Morgan or Goldman Sachs, has assessed that WTI will have on China opening around 30 to 40% of growth to $110, as I remember correctly. So for me, WTI USD is in a right place to buy, but you may wait for the correction at first, right? So there's supposed to be a floor building up somewhere around the levels of 77 and 78. So you may enter a WTI USD right somewhere around this level with an extension to 92 and with a possible stop loss set below 3.3% below this level. WTI also, if you want a confirmation for this one, you may wait for this one to get right here, and if it gets above this line, above 80s, it will strictly go to 90 with a high also full probability. So right away, if it gets right there, change your stop loss level to maybe a little bit higher to achieve a risk reward ratio at 3.2, as it's quite decent already then. So so that's it in today's episode. Thank you very much for watching. If you have any questions, just put it in the comment section below, as I can't find any on the chat right now. So I was very happy indeed you decided to turn on Blockrevision today, and I'd like to welcome you tomorrow at 8:45 AM East time as